Good morning, everyone. Welcome in. I hope you guys had a great weekend. Today, we're joined by Scott Liddell from Envestnet PMC team. He is Director of Product Investment Product Consulting on that team. And also, happy St. Patrick's Day to all of you that celebrate. Hopefully, you have your green on today and don't get pinched by your loved ones or your coworkers. Today, we are going to discuss direct indexing, just a general overview. A handful of you have reached out over the past several months, and even going back to a year now, asking, well, what is direct indexing and um, how does it differ from traditional investing methods like mutual funds and ETFs? What are the potential tax advantages of direct indexing for investors? How does direct indexing work in terms of customization? Is it a great fit or a right fit, viable fit for a high net worth client? So Scott here is going to take some time over the next 30 minutes to just dive a little bit deeper. So right now, I'll just go ahead and hand it over to Scott. Take it away.
Okay. All right. Thanks, Marcus. I really appreciate it. Yeah, as Marcus was saying, my name is Scott Liddell. I'm an investment product consultant here with Envestnet, and I cover all the PMC investment solutions and products at Envestnet. I'm going to share my slides here. What I want to talk to you today about is direct indexing. Our solutions at Envestnet are managed by our QRG team and called quantitative portfolios. These are our branded direct index solutions. So I want to talk just a little bit high level about PMC for a moment and our capabilities. I want to talk about what direct indexing is, and then I want to talk about the solutions that are available to you today that you can incorporate into your investment portfolios and your client investment solutions. So just to give you a little bit of a background, Envestnet is the technology that 110,000 advisors use to manage their practices and manage their client portfolios. We've been around since 1999. Over $6.5 trillion of assets is managed on the Envestnet technology platform. Throughout the years since 1999, we've gone through many different acquisitions, and we've built out quite a extensive investment support and product capability. And that's what we call PMC. So sometimes you'll hear the company referred to as Envestnet PMC. We're all one company. PMC is really the umbrella of all the investment solutions that we manage here. We manage $17 billion in multi-asset portfolios. We managed over $1 billion in fully outsourced full discretion, high net worth solutions in our private wealth consulting business. We have impact and tax overlay services for UMA accounts where we manage about $20 billion. But that yellow bar right there that says direct indexing portfolio, that's managed within the PMC team, and the division is called QRG. Our solutions are called quantitative portfolios, and there's a number of different asset classes, a number of different investment styles that I'll get into today. That are offered to you. We're the fourth largest direct index provider in the industry. We manage $13.2 billion, and we have over a 10-year track record, which is quite extensive for a direct indexer. So before I go into the specific product details, I want to talk about direct indexing, why there's so much growth in the investment solution, and why it makes sense from a cost perspective, from a performance perspective, from a customization perspective for many of your clients. So first, what is direct indexing? So as we all know, 20 or more years, there has been a move in the investment universe towards passive investing. Think of iShares and Vanguards and the trillions of dollars that they manage. Active management in certain asset classes has really had a headwind over the last few years. And if you do the research, and we've done the research, in certain really efficient asset classes like the large cap core space, the S&P 500 space, it has been historically very hard for active managers to outperform over the long term. So within the mutual fund and ETF world, as Vanguard and iShares will attest, there has been a huge shift towards passive investing, low cost, market class exposure, S&P 500, things like the SPY or the IBB, for example. But what direct indexing is taking that passive investment philosophy, like let's not beat the market, let's just pay less and get the market. But it's within an SMA construct, and there's a major difference between mutual fund, ETF passive investing, and SMA direct indexing investing. And that is because your clients own the shares of the stocks within the index directly, and they do not own a share class of the mutual fund or ETF. So if you bought the SPY or the IBB, or you had your client in those investments, there is one share class of those ETFs or mutual funds. And if the market goes up, your client has a gain, and if the market goes down, your client has a loss. Direct indexing in our solutions, we own a subset of the index and we track the index within 50 basis points. But we own, and your clients will actually own 150 names within, let's say, the S&P 500. We'll give you the S&P 500 performance with a subset of names through our proprietary optimization process, which I'll get into here at QRG and within Envestnet. And those 150 names are going to, in aggregate, provide the index return. But within each of the individual stock holdings, there's going to be gains and losses. There's going to be ability for personalization or customization. I'll give you a quick example. We had an advisor that had a client that was a CFO of an S&P 500 company, and he could not own his company's stock outside of a company-sponsored account, but he wanted to invest in just the S&P 500. What direct indexing has the ability to do, that I certainly tell you iShares and S&P or State Street ETFs don't, is literally remove one stock from the index and give you everything else, right? So what we could do is say, okay, we can screen by sector, we can screen by industry, we can screen by even individual names, and say, here's basically the S&P 500 without that security, and we'll put a no trade mark on that security. So ultra customizable down to the client and ultra personalized. The other thing that is really driving the popularity in direct indexing is the fact that within those 150 names, while on aggregate, they're giving you the index and the performance. Our large cap core portfolio was up 25.5% last year with dividends. The S&P 500 was up 25% with dividends. So we are giving you and the client that aggregate performance. There's going to be gains and losses across those 150 names. And even in a year that was so strong, plus 25% is a pretty strong year, I think we'd all agree. We had over 30 losers in our 150 stock index portfolio. So what can you do with those losers when you're in the ETF or mutual fund? Nothing. What can you do with those losers when you're in direct indexing? You can tax loss harvest those losers, and then take the proceeds. And we have a process where you can re-optimize to always maintain market exposure, but harvest losses throughout the year so that you can apply to gains in any part of your client's finances anywhere. Their losses directly to your client's tax statement. So direct indexing has been extremely popular. It's been growing just like the mutual fund and ETF solutions have on the passive side have been growing. And we have the research to kind of prove how certain asset classes is very difficult to outperform. So indexing at a low cost does make sense. And it's highly personalized, highly customized, and highly tax efficient. So our flagship, and I'll get into our solutions, we have 3 flavors of what we call the quantitative portfolios, and there's a number of different actual SMA solutions within these 3 flavors. The first is the simplest and kind of our flagship suite or series of solutions, and I'll get into the actual specific portfolios. We call it the market series. These are simply true passive SMAs. They're offered at 15 basis point management fee. You can get them across almost any asset class, US or international equity, right? Large, mid, small, growth value, international EM, even global. They come at $100,000 minimum. This is the market series. They have very low turnover, and they can be highly customized. It's about 150 names, as I mentioned. Come across all these different asset classes: all cap, large core value growth, mid core value growth, international, EM, global. I mentioned 15 basis points. These are our market series. I talk about the large cap core, the S&P 500 space. QRG manages about 13 billion in assets in these direct index solutions. Our flagship portfolio is our large cap core. We manage almost 2 billion just in this strategy. It's called Quantitative Portfolio Market Series Large Cap Core. It's a very long SMA name available to you. And part of the reason why it's so popular and we're managing, over $2 billion in it is because, as I mentioned before, indexing has a lot of fair arguments on its validity. Pay low management fees and get the index. Don't risk going active in an asset class that is so efficient. Our own research shows that over almost a 40-year period, 72% of active managers underperform the S&P 500. And don't just take our word for it. Morningstar has that research too. The 1-year failure rate of active managers in the US large cap equity space is 68%. And as you look over time, it goes up and up and up to the point where 9 active managers out of 10 in Morningstar on the large cap US equity space underperform their benchmark. So there's a real argument for going passive. S&P has the same research. As you go, kind of on the longer end of the investment time horizon, active managers really tend to outperform. You're paying 2 or 3 or 4 times the management fee for the likelihood of underperformance. It makes sense to go passive. So iShares will corroborate that. Vanguard will corroborate that on the ETF side. But what we are feeling the growth on is the SMA side, the direct index solution. So what we have offered is our market series, 15 basis points, pure beta across all these different asset classes. We have our factor enhanced series. These are tilted. If you've ever heard of strategic beta or smart beta, these set of solutions are 20 basis points. They are still low, are arguably low cost in the SMA management for an SMA management fee, but they tilt the portfolio to characteristics of the underlying stocks that have historically outperformed the market, right? Things like value, the tendency for undervalued assets to perform better than expensive assets. Momentum, the tendency for assets that have performed well to continue to perform well. Quality, low volatility. All these things are known as factors, which are characteristics of stocks that over time outperform the market. And while value may not be terribly in favor right now because of the momentum and type of growth names, if you go back in time, and I'm talking a while, those value characteristics and value factors, as they call them, have outperformed the market easily. There's a bit of a they've kind of, over time and over the long term, buying a cheap stock when all else is equal is better than buying an expensive stock. So these portfolios are the second flavor. We have the market series, pure beta. It's going to give you the index return, whatever asset class your client has, for 15 basis points. The factor enhanced series will tilt the portfolios to 2 combinations of factor. We have a value and quality combination, so you can get a large cap SMA that is tilted towards stocks that are exhibiting more value and quality characteristics, or you can get an all cap or a small cap that are tilting towards value and quality. We've also added a momentum component to a number of these solutions. So there's what we call value, momentum, and quality, or VMQ, and you can get a large cap, mid cap, small cap, all cap portfolio that tilts towards value and quality names, but also names that are doing well and have momentum behind them. So we have 2 combinations of factors that we offer across these portfolios, different asset classes. These are for 20 basis points. There's still a $100,000 management fee across the domestic asset classes. There's a $200,000 minimum account size. I'm sorry, not management fee, account size, minimum account size on the domestic asset classes, and $200,000 on the global. These are index-like turnover, not high turnover, but they have the ability to beat the benchmark because they're tilted in a different fashion than the index that they're tracking, but they're doing it in a low-cost strategic way, tilting towards those factors. So we have the market series at 15 basis points, factor enhance that maintains the ability of outperformance, but also at a low cost at 20 basis points. Both have $100,000 minimum. For a lot of solutions on these in these portfolios, I'm happy to answer any questions now or get on a call with you and dive in deeper or explain these portfolios at a later date. But right now, I'm just going to pause, turn it over to you, Marcus, and see maybe if there are any questions at this time.
Yeah, thanks, Scott. Great job. I don't see any questions right now. I'll tell people who are watching, if you have any questions on this, if you want to see what's available from this group, I do want to share my screen to highlight. There we go. We want to share my screen to highlight some communication I sent out over the past week about the research center. So as Scott was going over the portfolios that are available with QRG, I sent this out, letting you guys know how to utilize the research center on Envestnet. If you have any questions on how to utilize it after viewing the video, please let me know. But if you want to see what that looks like on the research center, you can go to the filter tab here and then just type in quantitative. That's the quick way to just find everything that is available from what Scott has discussed today. And then here under SMAs, you'll see all of the options here. And then you can click into each in one of those portfolios and look at the performance statistics composition as well. As of now, if you guys have any questions, just send an email out to me at wealthsolutions@stonex.com. I'll be happy to answer and have Scott join us on a separate call if we need to do that. With that said, I'll let you guys get back 8 minutes of your day. Thank you for taking the time to join us, and have a great rest of your week.
Thank you.